Hey, this is David Skrika. I hope everyone's good. Stock chart of the day. So, I know I haven't done as many as usual. So, what I sometimes I do like get into situations where I'm doing a lot of stock deals, or I do marketing for companies, and sometimes or when I'm doing a stock deal, sometimes I get people in. I have to help them with the paperwork, etc., and or just other things like editing in my book. I'm working for this new website called Dollar Collapse, and Stock Chart of the Day is a free service. The weekly paid members always have their one update a week. So when these things happen, sometimes I can do a little less, but I'll always make it up for you. If I do have a week where I only do one or two charts, we're going to do something that will be a little more in depth to make up for that. So I'm going to try not to have this happen too often. But today's, and then sometimes I'm going to be honest with people. I'm honest. I'm always going to be honest with you. Sometimes I get burnt out. Like on the weekend, this past weekend, I was going to do all these videos, including for this. I just did one for the site I work for. And I don't know. I woke up Saturday and Sunday morning. It was just like, it's a beautiful day here in the Bahamas. The breeze is blowing. I'm watching Premier League, and I'm just, I watched the second Dune movie. I bought it off YouTube. I watched a great interview with Nigel Farage. So it's just kind of like, I don't know. I just like, I'm not, because you need time to decompress, right? Like, it's like your mind is like a muscle, as they say. You have to keep working it so it's active. That's why I think people who retire early are likely to get dementia and that sort of thing, because they're not keeping their mind active. But on the other hand, being like a muscle, if you overwork it, you can burn out as well. So that's that's I'm just having some club soda while I do this. That's kind of where I am with that too. So anyhow, I hope you appreciate that. I apologize sometimes when that happens. I'm always honest and open about things. So anyhow, so what we're going to look at here today, though, so this is going to be, I think you're going to see, really make up for it. This is a great thing that I just come to the conclusion of, because it had to do with this stock, Carvana. So Carvana, if you don't know, it's just like an online, like CarMax, like an online company that sells cars online, et cetera, et cetera. It was created in 2012 by a father kind of son team. And, the stock did great, came public, you can see here in 2017, went from $10 a share to about $360 a share. But Carvana, as it became obvious that interest rates were going to rise, also these premiums that cars were getting because of the, supply chain issues, because the COVID, that was ending going into 2022. So combination of higher rates, meaning leasing, borrowing was more expensive in cars, that supply chain thing, and used cars being worth so much, prices coming down, was a double whammy for Carvana. Their sales collapsed. They had a lot of debt themselves. And you can see the stock went from $360 a share to $3 a share. But notice that Carvana, we'll zoom in a little more on the topping period so we can see this better. It peaked here in the middle of 2021, where the market peaked here in late 2021. So Carvana had basically already gone from 100 and we'll zoom on that period even a little more now, from like $380 a share to almost half of that by early 2022. So it was rolling over for the market. That is the thesis of this video you're going to see. We're going to look at sectors that kind of were rolling over before the market did. And what happens, because a lot of these stocks and companies and sectors are down a lot already when the bear market is starting, the bear market whacks them even more. And then they become so cheap that, that they're worth looking at here. So, you can see this happen with Carvana. Now, it's tough to get the exact bottom because Carvana would have looked cheap at $20. But, again, I think that's where you have to combine it with kind of looking at the market. In 2022, the market was still falling into the fall. Or you can always use a stop loss. You could have bought Carvana at 20. And as we see, when it broke down, you could have sold it at 16 and then kind of waited for your entry point, right? And you can see finally, when it went to $3 here, $4 here, it would have been a good buy. But again, Carvana, business is rolling over, blah, blah, blah. But, you could have viewed it as a sort of turnaround play. And we look at it, you can see these last couple earnings, the gap ups on the earnings, unlike in 2022 when there was the gap downs, etc. And Carvana has done great. So you could have bought at $3, $124 now. So basically you could be up $4, you're up 30 to 40 times in your money. Let's say you couldn't get that exact bottom. Your average price was like $7, $8 in here, $6, $7. You still be up nearly 20 grand. So even if you only had a small amount of money, $1,000, $2,000 to invest, that could be 10, 20. I'm kicking myself for not doing something like this. But I'm learning all the time too. Like, I know I may seem old because I've been doing this for 25 years, but most traders really kind of get into their max, like profitability when they're like my age, because you have the combination where you're still young enough, you still have that energy, but now you have knowledge. It'd be tough for me to learn about this 25 years ago because I was just starting out and I didn't know a lot of these things. So I started just researching all of these companies or sectors that are like this. Like, let's look for companies that peak out before the market and then get hammered more. And then it's the George Soros reflexivity, the John Templeton maximum pessimism. It's these companies are more beaten up and cheaper than the rest of the market, so they can reflex or move faster to the upside. And in something like Carvana, it doesn't have to go back to its all-time highs just for you to double your money. Like, even if Carvana, if you were lucky enough to buy, say, at $5 a share, the stock goes back to 50, you're up 10x. You can just sell and get your money back and then ride the profit. And at 50, Carvana is still a fraction of its recent highs. So, then I was thinking about other sectors that I knew did this in the past. Like, two other sectors we're going to look at are airlines did this back in the airlines did this back in the early 2000s. Airlines peaked around in 1998 because if you remember, oil was low, traveling was cheap. It was pre 9/11, so there's no all these security concerns. And then they kind of held up into the 2000 tech bubble. You can see the airline index all-time I was over 200, but it was still trading at 160, 170 at very high levels. 2000, 2001, of course, 9/11 completely changed that. The airlines, travel dried up because of worries over terrorism. It became more expensive for the airlines because they're going to have more measures they had to take, for security, et cetera, et cetera. So that was one of John Templeton's trades, by the way. He actually bought the airlines here because he knew that they would pass a bill to bail them out, and he sold it here. So it wasn't a long-term trade, but he did very well. Most of the airlines, double, tripled in roughly 6-month time frame. But they eventually went lower in the 2002 bottom, and you can see even in the rebound, they really lagged in that bull market, and then they finally hit the final bottom. So this airline index, which had peaked at 200, was under 15. I think it was like 13 here at the bottom. Again, we zoom in on that 2008 period. Let's see where it was. You can see, 13 here in March of 2009. So down over 90% from their highs, probably worth a shot at again. And then you could see airlines, boom, like soared over the next few years. Literally, airlines soared. I know, forgive the pun. And you can see the airline index went to 108 from 13. So it went up, like eightfold. And these are not, again, these are big. This is Delta. This is American Airlines. This is Southwest. These are big companies. Let's put on Love, just for the sake of it here. You can see Love, which peaked, bottomed in the financial crisis at under $5 a share, was 44, and you could have bought it for as low as 7.5. And just basically a 1, 2, 3 year period, it went to it went up sixfold in value. If we go look at JetBlue, look the same way. Yeah, JetBlue again peaked at under 4, or bottomed at under 4, and it went to as high as $27 a share in 2015. So again, an industry that had lagged for a long period. The final washout was the 2009 financial crisis, and as well as the market has done since then, okay, you could have bought the odd growth stock like Nvidia, but for the most part, the airlines being up, 8 to 9-fold by the mid 2000 teens outperformed every sector basically. So that just shows you, again, beaten up industry had been going down for a lot longer than the market. And then because everyone's so negative on it, and no one even talked about airlines. So another industry like that back then was the casino stocks. So when you can see here, when we'll go back to 2007. So when topped, here, it actually topped with the market, but it began to vastly underperform the market in 2008. And at the bottom in 2009, Wynn had gone from nearly $100 a share to under $10 a share, down over 90%, when the market at that time was down roughly 60% from its highs. And in Las Vegas Sands and you can see then when boom, boomed the next few years, partly because a lot of these companies expanded in Macau, and Macau really increased their profitability because China was still booming while the US was just recovering. And when you can see went from under $10 a share to $120 a share, 12-fold increase. Las Vegas Sands was even more impressive. You can see Las Vegas Sands went from about $80 a share to just over $1 a share. People thought they might even go bankrupt, and boom, by late 2010, so really about an 18-month period, had gone from just over $1 a share to $40 a share. So again, a sector that really lagged, really did poorly during the financial crisis, etc. All of a sudden, you have to have guts to do this, though, because at that time, when it's here, it's not as easy as saying, "Oh, this is going to be great." But no, when it's trading like that, it's like people are very negative. They think it's going to go under. People thought airlines were going to go under post 9/11, and airlines would never be the same again. And same thing with all the debt and the slowdown in real estate and housing that occurred. People thought that these casinos would never be the same again, and of course they ended up doing well. And I think a lot of them, I think Las Vegas Sands never went back to its all-time highs, but again, you can see it was so beat up. It still went back. Ultimately, it went back to $50 to $70 a share, which again, huge returns from the bottom there. So then another stock I want to look at is, it doesn't have the I'll show you an example of this, is Tata Motors. So Tata Motors, the Indian company, used to trade under the ticker Tata, has done this 2 times. So we're going to go back nearly 20 years in Tata Motors. We're going to go back. So Tata Motors, you can see, kind of again lagged here. Remember in 2007, sorry, the market kept hitting new highs. Tata peaked out actually before the market, started to roll over, and then by early 2009 was trading at the time, it was the equivalent of about $3 US a share. And then it rallied huge. I actually bought it the day before it bottomed in the newsletter, and in an account, a family member's account. So then Tata went to 500, and then down to here. So like that's basically what's kind of gone on here in Tata Motors since in the last 10-15 years. And we see the 2017 high was kind of a double top of the 2015 high, but it started to go down for years. And while the market was making new highs in 2019, it did not. And the Tata's last flush out was a 2020 COVID crisis. And Tata since then has gone from the equivalent of about $5 or $6 a USD to about $20 US, to $100 USD. The rupees is just over 90 rupee, a dollar, right now. So you have to take that into account, blah, blah, blah. So I'm using a lot of the prices I'm using are like in today's prices or what they were in dollar prices then. But what you can essentially see is that Tata went from 50 rupees to about 60, 70 rupees in a course of about 3 years, lagged the market, got flushed out, and then really outperformed the market, So that's kind of what we're looking at here. We're looking at stocks and sectors that for whatever reasons, like another stock I'm going to show you that did the same thing is DDD to 3D printers, which peaked in 2014. And you can see it peaked at $100. Into COVID, it had gone down 95%. There was a little rally after the bubble burst in them to about $20, and then it went to $5, and then boom, it spiked to $50, and did it within 6 months, or did it within 8 months. So this stock went up tenfold. We're like, even the hot stocks were going nowhere up like that. So another example. So what I'm looking for now, and so Tuesday, my paid subscribers will get an email. I've got a bunch of companies that I'm looking at, that have in sectors that have kind of lagged the market, that I think will be the bottoming sectors. If I'm correct, I think we're going to have a much larger correction this fall or sometime early next year. And when that larger correction occurs, I think these are the companies might have the final flush out. If you want a little like sample, DDD would be one of them because it's now trading at $3, $3.50 a share. So that would be one of them. You know, you can see in 2009, it went to over $1 a share. I think you could do that in a flush out in the markets again, and then you can see what it did afterwards. But it even doesn't have to do that. Even in 2003, when DDD kind of went down with the tuck bust, you know, it went from just over $1 a share to $6, $7 a share. You know, and again, look at DDD lagged the market. It didn't really go above its 2005 high, even as the market continued higher, but was a much better buy at the lows of the market in 2009. So, you know, that's the kind of thing I'm looking for. So, and I've come to this conclusion. Like I said, I'm now studying all these past sectors, et cetera, et cetera. You know, like gold stocks are kind of like that in 2000. 2000 gold stocks had been going down for years. They went down with the market really in the first phase of the bear market into about December of 2000. And then, of course, they vastly outperformed over the next 3, 4, 5 years. So that's what I'm looking for. I'm looking for stocks, companies that have been lagging for whatever reason. And then, you know, when you get one of these flushes in the market, as we've seen in 2020, everything went down during the COVID crash. And then these stocks all kind of all kind of outperform, you know, on the way higher. I'll give you one more stock to look at. This was Crocs, and Crocs was kind of the same way. More than, you know, peaking before the market, Crocs vastly underperformed and went from, you know, $60 a share to just over $1 or just under $1, and then rallied back to 30. So again, when the stock market recovered these 2 years, you know, the S&P roughly doubled in these 2 years, from 2009, 2011, and Crocs went up 30x. So that's the kind of thing you can see. And then look at even Crocs here. Obviously, does not have this underperformance now. Now it has started to move. You know, it's over $100 now, but you can see even here during the COVID crash, it went back to under 10, and then was like 150 by the top of the market in 2021. So again, top Crocs underperforming for years, but again, the final flush out here, and you know, where the rest of the S&P did well from the COVID crash to its top in 2021, I think it may be the S&P doubled in that time frame. Crocs went up 15-fold. So again, finding these companies that have underperformed, and then that kind of flush out is their kind of final selling capitulation, and then they reflex faster. That's kind of what I'm looking at. I'm going to have specific companies for my paying members, you know, in our members version tomorrow. Some of them might be some of the companies talked about here today, but I'm going to look at more in detail. Here I'm looking at the past, and my members update on Tuesday. I'm going to look more at the future. More, okay, this is the companies. This is where, you know, kind of price targets to look at, price points. Put them on your watch list. Put them on your radar. You know, more companies in a specific industry, not just one, et cetera, et cetera. So I hope you enjoyed this. I think this was kind of a unique look at the markets. And like for example, let's just quickly look at the S&P to end off here. And again, you can see, yeah, the S&P went from 20, it basically doubled. And I've just shown you, like, DDD went up 10x, Crocs went up 15x. You know, TAD has gone up 20x. You know, so again, buying these beat up deals, and you're buying cheap companies on good value. The issue, okay, you could say, oh, I should have bought SMCI or should have bought NVIDIA. But, you know, NVIDIA and SMCI were never really cheap companies. They were growth companies who just got into AI, right? Where these companies, they're making similar type returns, but you're essentially buying a company when it's cheap and then selling it when it's no longer cheap. That's the way I like to trade, not the buy high, sell higher philosophy. So I hope you enjoyed this thing. I think this was an interesting thing here. I don't own any of the companies mentioned here, et cetera. There's a couple of companies I've been trying to trade for the last year. One of them, about 5 of them, 2 of them are in marijuana, 3 of them are tech deals, and one of the 3 marijuana deals actually has ended up doing okay. Took a while longer. I just sold one of them for a gain of about 60%. The two of the 3 tech deals have not done well. They've lost money, but again, they'll probably get flushed out. And then the other tech deal did pretty well. It you know, went up about 40%. But again, I think all of them, like that's not the kind of gains I'm looking for in those trades. These are the gains. These are the stocks you want to make 5, 10, 20 times your money on. So that's kind of what I'm looking at. And I think if there's a final flush out or capitulation in the stock market, we're nowhere near there. The market's much closer to its highs right now. But at some point when there is another bear market, we can do that. We can look at these kind of deals, And by the way, another example of this, why not? I know I'm going a little longer than I should, but let's look at CLF. So iron ore was like this in 2015. So in 2015, the S&P had its first major correction in about 4 years. I was convinced in 2015 the market was going to crash. Okay. I was like, the global economy is weakening. That's why these commodities companies are going lower. They're going to start raising interest rates, which they did once in 2015. The market's all predicated on cheap money. I wrote 2 books on it. One was called Bear Market Rising in 2015. And I did well in some shorts. I think some of you who are long-term subscribers shorted Skechers with me, which collapsed in price that fall. But anyhow, in 2015 was a classic example. Cliffs, which had peaked at over $100 a share in 2007 before this, and then gone back to $100 a share, went all the way back to $1.25 a share at the bottom in 2015. And again, even though it went nowhere near its highs, if you had owned Cliffs into that 2021 top from that 2020 bottom, you made over 20x on your money, right? Like not many companies have made over 20x their money. And this is iron ore. And again, you could have bought it again back at 250 during the financial crisis and made 10x on your money. So again, a company that's beaten up, was cheap, lagged for years. And again, the nice thing about buying companies like that, like, look, even when Amazon went down 50% or, Facebook, 60, 70%, they needed a double or a triple to get back to all-time highs. When a company goes down 90%, all it needs to do to go to all-time high, or for you to make 10x, it could still be a fraction of its all-time highs. Like if it's down 99%, like Cliffs was, when it's down 90%, you're still up 10x, So it's just basic math. So again, I'm going to be looking more for like companies, industries like that in the update I have for members. I hope you enjoyed this because I don't ever see. I think this is a very unique way of looking at things. Again, so looking for companies, looking for industries that underperforming during the bull markets, or really begin to underperform during the bear markets, and then kind of get flushed out in that selling capitulation, and then lead the way out of words again, because you're going into George Soros's reflexivity, where they're going from being vastly undervalued to overvalued. So everybody take care. This is why I'm getting excited now, because I do believe there is going to be some kind of issues in the markets the second half of this year or next year. And we're going to finally get opportunities like this again. And look, I have to admit it, I wasn't aware of this sort of trading strategy even a few years ago. So like, I try to learn as much as I can. And then if I find knowledge that I think is valuable, I try to pass it on to you. So I hope you enjoy this. And I hope you think that it's a very, very unique way of looking at markets.